Hello, everyone. This is Mohammad Akif with Akif CPA, and today we'll be discussing cleanup, QuickBooks cleanup, accounting cleanup, Xero cleanup uh, checklist. Right. So this is for people who are in a mess. Their QuickBooks is in their mess. Their Xero is in their mess, where things are not making sense. Everything is out of out of order. Right. The accounts don't make sense. We have negative balances. We have positive balances where they shouldn't be, and then so we have a checklist that we normally use internally, and then so this is for people who are working on their QuickBooks, for clients who are working on their QuickBooks, for other accountants who are working on cleaning up. So this is the checklist we normally use internally in our firm, and then it goes through many different places in terms of, okay, what should we be looking at, how should we be doing this. When we are doing cleanup, it is a technical thing that we're doing, right? It is a one-time thing that we are trying to fix. We're trying to fix the health of the accounting, the financial information, and bring it up to date. But that's the key here, right? So there are a lot of things that happen when a client comes to us and then gives us this, okay, you know what? Please fix my QuickBooks. It's easier said than done, because when somebody says they fix our QuickBooks, that means it could be anything. And then how do we get to conclusion that what needs to be fixed, what needs to be looked at, how it needs to be looked at, and then the way it should be looked at, right? So and then the conclusions, and then the work. So it's many different steps, but today our checklist is to give you an idea, give you a summary. I'll be going through some of the main points. I'll be going through some of the small points, skimming through some of the points which is unnecessary, but of course it's part of our own work, but at the same time giving you details in the middle how this should be done. So this whole video is divided up into certain things, right? First, when you have a accounting a QuickBooks or Xero cleanup, what do we initially look at? And then, so on a summary level, that's number one, right? On a summary level. And then number two, in terms of detail, each account, what are we looking at in each account? So I'll pick the main ones where we normally work, where this is more of a problem, and then you can decide, okay, how this should be working. So it is a checklist internally. We'll be putting this up on our website too for you guys to access and get this information. But I wanted to have this QuickBooks cleanup checklist or Xero cleanup checklist for you to have, where you can review what you can do stuff what we're doing. Of course, not everybody's an accountant. So if you don't understand, if you don't know what you're doing, reach out to us, info@akifcpa.com, and we would gladly help you. Again, info@akifcpa.com, and we will gladly help you with the cleanup. Okay, so let's get started. I'm going to share my screen with you so you can see what I am seeing, and then we all can be on the same page. All right, so where is it? All right. Where's my, okay. So window, Chrome tab. I cannot see. Let me close this and then open back up again. Save. All right, come on, computer. Come on, laptop. I need your help. Okay, so hopefully this can work. Perfect. All right. Now I can see. All right, so so let's get started. I mean, so this is so overall, once we get access to QuickBooks or accounting or Xero, what do we do the first time, right? I mean, this is very important. What we do the first time is that we get access to information. We get we get copies of certain things. So the main thing is, first of all, looking at financial data, looking at data in comparison, looking at data, matching the data with what has been filed with the tax return. So normally we request tax returns, we request access to the QuickBooks, Xero, and then we pull reports. And then why do we pull reports, and what kind of reports we're pulling? So we pull profit and loss on year-to-year basis, balance sheet on year-to-year basis, in comparison, so we can see the accounts, so we can see what was happening, we can see the differences, why there's certain accounts were been negative. We can see a summary of what has happened so far, right? So if it's a 2-year thing, it's a 3-year thing, we do a 2-year, 3-year comparison, and we want to make sure that we can see all the accounts in summary. And this is what we're looking at initially. So we are looking at the accounts with comparison, to look at how things are happening. So for example, we are looking at We're trying to find discrepancies. We're trying to find odd balances. We're trying to find accounts which are negative. We're trying to find accounts which are in the wrong statements too, right? So these are things that we normally do, and then look at what has happened, where things look out of out of order in certain accounts. Why there's so much in negative? Why there's so much in positive? And these are things that we're looking at. So the first thing what we do is, again, we pull reports, we do it in comparison, and then we go line by line in summary to find out what is the problem. And then again, we compare that to the tax returns that have been filed, because that is important, right? The excuse me, the tax returns are one of the most important things, and then we need to make sure that we are looking at those two when we are fixing QuickBooks. A lot of accountants and bookkeeper miss this, because what happens is they are just given bank statements, they're just given certain information, and then they're supposed to fix the QuickBooks. That is or the Xero. That is the wrong way to do it. You must have tax returns. You must be able to compare them. They should match with the accounting software, with the Xero and QuickBooks. If they're not matching, there's something wrong. So that needs to be looked at too, right? So it's just not about what has happened in the books. It's also about what has happened in the return, and are both comparable or not. So again, then this is the first part. Then we do a whole summary in terms of just the overall high summary, how where things are missing, what we are looking at, what are the differences, and so that's the starting point. So once we have identified the issues on the summary level, we can see what is happening. Then we start going into the detail, and then the way we do this is we start with balance sheet. That's first. We look at the assets, and then second part we'll be looking at the liabilities, and third part is equity. So again, the first part is the comparison of the statements, the profit and loss and balance sheet, and the comparison of the tax return. That's review of the tax return. That's number one. Number two is then we go into detail. That first one was summary. Second is we go into detail. And once we're going to detail, I'll go with what are the main accounts that we're looking at once we go into detail. The first thing is, of course, the balance sheet that we are looking at. So you can see what I so again, before we start working, of course, you got to make sure that you download all the reports before you start working and correcting it. That's the key here. That's something that needs to be done. So first thing first, the chart of accounts, are they in the right place? Are they in the right profit and loss statement and balance sheet? Are they in the profit and loss accounts or the balance sheet accounts? If there's something's wrong, then that needs to be changed. This is the first thing, right? I mean, the classifications are within those accounts. So first thing first needs to be reviewed is chart of accounts. Once you're able to identify if the accounts are in the right statement, the right profit and loss statement, or the balance sheet, then you can go fix them. So again, let's go into the balance sheet. Number one is we're looking at banks. So when we look at banks, what we do, we look at the balance. That is what is happening. If it's a big negative, that means we know there's something's wrong. Secondly is we look at the reconciliation report. We gotta know the reconciliation. Did someone did the reconciliation? Was there anything wrong with the reconciliation? To look at if it was done, look at the reconciliation report, see what was happening, right? If there were a lot of unclear transactions, deposits, checks uncleared before the date that was clear, reconciled, something is wrong. Something is wrong really badly, because that shows that this whole accounting thing is because the bank are the main thing, right? You're getting information. All your transactions are happening at the bank. All your transactions are happening at the credit card. So if these two accounts are not reconciled, something is wrong. If they're reconciled and then there's a lot of unclear transactions, then something is wrong even more, right? So you got to make sure that we know that reconciliation was done properly. We got to know that it was, look at the report, how it was done. If they were not done properly, then we need to investigate more. We need to find out what really happened. Look at the bank statements. Look at what was happening. So it could be 1 year, 2 year back, 3 year back, depending on how the health of the reconciliation report is. So that's where the assets comes in. Of course, then we look at the inventory over the opening balances, starting balances of the inventory. We got to make sure that is also on track, right? We don't want inventory to be negative. How inventory can be negative? It's always you got to have something to sell something, right? So you got to have a number, a stock to sell something. So if an inventory account is negative, that means there's something wrong. So that's where the account receivable. If you're most likely, I mean, in account receivable, if you have negative account receivable, that is something wrong too. that that needs to be verified. Make sure if you're using the software to create invoices, that means if there are a lot of them they're pending invoices, that means we need to investigate that too. If there's a negative account, we need to investigate that too. Undeposited funds, right? I mean, so this is part of the invoicing. If you're using, then you will have this. If you're not using, then you won't have this. So a lot of people, when sometimes when majority of times when we are working on their accounting software, a lot of companies do use it, and a lot of companies don't use it. So the undeposited funds will only come when you're using the accounting software to create invoices, to collect payment, to set invoices, and then this is where it will come in. Again, inventory, I've already touched on it. Opening balance of, let's say, this is assets. We gotta look at the asset purchases. Was they recorded? Look at depreciation. Was that recorded or not? If something was sold, was that also recorded or not? So then that also comes from the tax return, right? We're gonna match it with the tax return. See what the books have, and then what the tax return has. That's important right there. Investments, I mean, of course, if there's some investments being done, we need to make sure we get the initial paperwork and see how the investment work going. Secondly is liabilities, right? So liabilities is something that you owe. You look at, accounts payable. If the bills that you're putting in, that's something that we need to look at. If they're negative, that's also a problem. Payroll liabilities, that's the biggest one. I want to spend some time on this too, because get your reports, get your 941, the state reports, see what has been done, get the payroll summary, and make sure that we are correct. We are properly recording liabilities. That means what the taxes that you need to pay to the IRS are being recorded properly. If there's something wrong with this, or let's say, for example, the liabilities have a negative balance, that means that more money has been paid out than it's been recorded. So that, if that is wrong, that means your wages are wrong too. Everything is connected, right? So if the liability part is wrong, your wages might be wrong. And then how do you find out? You find out through reports. You find out through checks. You find what you have paid, how much deductions you have taken out. So this is one of the main ones too. And then a lot of people make a lot of mistakes on these, because of course, we have deductions when we are paying someone as a W-2 employee, and then those deductions will have FICA, Social Security, Medicare. How do you record that into liabilities? And then we will have company taxes too, right? So this is the key here. And then this is where a lot of people get things wrong. So the long-term liabilities, anything that's big note, this is also a problem. For example, you have a loan from a bank, and then you have 400,000, and then you're paying 2,000 on it per month. In a lot of cases, what I've seen is that somebody will just put 2,000 and then minus it from the long-term liability. So that is just wrong. You know why? First of all, it should not be that way, because the payment has interest and principal included. So that means, if you're putting the whole amount in there, your liabilities balance is off. Secondly, your principal balance is off. Your interest payment, also off. And then you're also going to be paying more tax on the income. Your profit and loss is off. You know why? Because the interest is not being recorded. If the interest is not being recorded, that means it's not being deducted. And then, so if it's not being deducted, that means your profit is higher, right? So deductions are missing. Profit is higher. And then, so if that means more tax. See how it is all connected? No interest, profit being higher, more tax. And then, so make sure that, these are small things, but they do add up. The key here is that all these mistakes add up, right? All these mistakes make a big impact, and then they play a big role in terms of how the taxes are going to be, how much money you'll be able to keep, right? That's the key here. So you look at all these, again, the liabilities part is interest, how the interest being calculated, the principal, are they being recorded? Is your principal balance off, interest off? That's something that we need to look at. Equity balances, this is based on what kind of company it is. If it's a sole proprietorship, partnership, S Corp, C Corp, how the money was put in, who put in the money. And this is something that, again, more in-depth detail. I'm not going to put a lot of time into this, because this is even longer. I'm just going through the checklist right now. All right, so now we're moving into income. This is the profit and loss side of the statement, and then on the income side, of course, we have sales verified. The sales were properly recorded. If you're collecting sales tax, make sure the sales tax is not included in the income. How do you make sure that? Again, we got to look at the income and revenue. How is that being reported? The sales tax, the income should be coming out. Other expenses, again, categories that we need to look at. This could be identified. This is the easiest part of the whole thing. A lot of people are able to get this right because they know what they're spending, and the balance sheet is what really gets to them. So this is again, reports and analysis. We look at all the statement, balance sheet. We discuss the findings. We discuss what needs to be done, and then that's how we do this. So again, this is a post cleanup task. This is a whole list. I mean, I just came through the main ones, but QuickBooks cleanup is a very, very, very extensive, detailed work. It requires a lot of expertise. A lot of people are. I've seen a lot of bookkeepers, accountants make mistakes. I've seen a lot of even some cases, even experienced personnel also making mistakes, right? Because sometimes the understanding of the accounting is not clear. Sometimes the understanding of the transaction is not clear. So make sure you find a firm that can really help you. Find a CPA, find a even a bookkeeper that knows what they're doing, knows your business, knows what you're trying to achieve, and then look at what has happened, right? The only way you can fix this is to understand the client, to understand you, and then to understand your objectives, what was done, look at the whole story, and from there on pick up and fix it. Because otherwise what is happening is you might be paying more taxes because your books are off, right? Or you won't be able to get a loan because the banks look at your statement and say, this doesn't make sense. How this guy's, how this company is doing this and this and that. So a lot of them know how to read reports. So if you have proper accounting done, proper bookkeeping done, then you won't have an issue. Again, if someone has messed up, we can fix the QuickBooks for you. We can help you get this back on track. We can do a one-time job, a great job, where you can take a financial statement, go to your bank, say this is what is happening, and then really trace back, and everything is properly recorded. So again, reach us at info@cpa.com, info@akifcpa.com, with any QuickBooks Xero cleanup issues. We can do a one-time job, and then we'll get you back on track, because great bookkeeping will save you taxes. It will give you financial data that can result into financial tax planning that can save you taxes. Again, great bookkeeping leads you to tax savings. That means more money home for you.